everyone, and welcome to this month's version of your Daily 5. I am your host, Mish Schneider. And since we are in a situation where the market has had a correction, I thought it would be really interesting to review some of the key charts in understanding how we will know if the market correction is actually over. Generally, a typical correction is anywhere between 8 and 10%. And if we just look at the Qs alone from where it peaked out to where it landed on Thursday of this week, it is about a 10% correction. And on Friday, as I'm talking to you, we're getting a bounce. But what we want to understand is if this bounce is going to be sustainable. So I thought the best thing to do would be to look at some of the key areas. Even though Qs are a part of the key, really it's always for me the economic modern family and their outliers that give us the best picture. And in fact, when we look at some of these, you'll see that even when the market was correcting, they corrected a little, but certainly never flashed anything even remotely like a bearish signal. If anything, there were a couple of indicators here that told us that perhaps this was just a correction, and if we were a little patient, we'd have some opportunity. So now let's move on and start with the granddaddy of the modern family, and that would be grandpa. So this here is IWM, and you can see that it's in a caution phase. So let's take a look at what a caution phase means. It means, first of all, that it's trading beneath the 50-day moving average, but the 50-day moving average is still above the 200-day moving average. And it also means that the slope here, although slightly positive, is actually telling us now that we can measure whether or not this is a weak or a strong caution phase. And with a positive slope in this overhead 50, that would make this a actual weak caution phase. So that's a positive. Then, of course, we could see that at the March low here, which was even further down here at 208, we didn't even get anywhere near there, with the low this week coming in at 211.54. That was a couple of days ago. So at this point now, we can say that looking at the momentum indicators, although the momentum is starting to come back, we're still not necessarily out of the woods. What would put us out of the woods, particularly in the IWM, would be two closes back over, let's call it 223. That would put it back into a bullish phase. And I think after this correction, especially if we see the momentum increase, that would mean that regardless of all the doom and gloom, this market is still ready to go up. Now, as far as the leadership against the benchmark, you can see that it's also not showing leadership. So this needs to prove to us a little bit more, which tells me that I wouldn't worry about fear of missing out at this point. If this is good, then come next week, we'll see it actually continue to stay firm and maybe tackle that 50. However, one of the better signs here is in the retail sector, which went into a confirmed caution phase again weak because the slope on the 50 is positive. But at the same time, what you can see here now is it's getting back over the 50, and yet we still have a little bit of a troublesome divergence here in momentum. So even though, again, another good sign, you want retail to be strong, obviously consumer economy, but at the same time, you also want to see these momentum indicators at least clear back over the 200 and back over the dotted line, the Bollinger Band. And in terms of performance, it's starting to show some leadership quality, but not quite yet. So this needs to hold up for sure. Now, the most interesting one of the modern family is the transportation sector, and there's a couple of reasons why for that. First of all, this reflects the back to work trade, people traveling again, going on planes, going to hotels, going to travel in general, driving their cars. But it also reflects whatever optimism we have as far as a infrastructure plan that could potentially happen. What's interesting here is after it made a new high, it gapped down. So really, technically, what you need to see now is this gap to get filled up to 278.12. So far, the high today is 277.50, which means this gap hasn't gotten filled. So even though this is still in a strong bullish phase, based on this reversal pattern until that gap gets filled and really ideally taken out. Again, this could just be a rally into resistance. What is decent here is although the momentum has come off, at least the momentum has come back to over the 50-day moving average. And the leadership here you can see is still very, very strong. So you really need to keep your eyes on this transportation sector. And let's hope, if you want to be a bull here, that we see that gap getting filled. The next one is semiconductors, which was one of the first ones to go into a caution phase when it broke down here long before IWM did. Certainly IYT we saw hasn't, and also long before XRT did. So semiconductors don't necessarily need to lead the market, and of course chip shortages are affecting it too, but you never want to see this fall apart because that would be a drag to the whole thing. Now what I see here again is a weaker caution phase as the slope remains relatively neutral on the above 50-day moving average, and we held a pretty good level here at 225. Momentum is weak, but starting to come back, and clearly you can see it's weak against the benchmark. So in order for this to get even remotely interesting to me, I'd like to see another couple of closes over 240. And then the other thing, of course, is we want to see it hold 225. So if we put it all together, if this breaks down under 225 with the, let's see if IWM can get back to the 50, let's see if IYT can fill the back, and let's see if XRT can get a second day above the 50, that would tell me, if this breaks 225, that this is nothing more than a rally into resistance, and it's time to be relatively cautious. So there's that. Now, if we go on to the, and of course, by the way, if we go through 240, that tells me that actually things are in much better shape than the pundits would like you to believe. Now, in terms of regional banks, of course, which is very interest rate sensitive here, that never broke the 50. Well, it did down here, but since this correction, this hasn't broken the 50. And even though it had a sort of a reversal pattern, it wasn't a really good one because it wasn't a new 60-day high. So now with this coming back over 70, what this is telling us, of course, is that the regional banks are still doing well. This is the regional banking system, even though we're getting a decline in regional banks across the country. But we still want to see this hold 70 now and continue to move up, particularly in momentum. It's gotten back over the Bollinger Band, but you can see the divergence. It's under the 50-day moving average while it's over the 50-day moving average. So again, a positive sign, but not like let's just jump in and not worry about it at all. What is good too about the regional banking sector here is that it is holding in terms of its leadership. Now, if we move on to the last member of the family, this is biotechnology. Now, biotechnology not only broke down under the 50, it broke down under the 200. What is interesting here is that after we had this big bar, it actually closed back above. And even though it's been struggling, today we're back above that 200-day moving average. But look at how weak our momentum is. We actually broke down under the zero line. So we'd want to see this at least get through the Bollinger Band. And I would say, why mess with it? Here we have an upward sloping 50-day moving average overhead. Let's just wait for this to clear 152 for a couple of days. And if it does, then we can say biotech has bottomed. And I would actually even say that at that point, then you have a good risk to under this low right here, under 146.85, to see if this can get back through 160 and higher. And this is actually turning out to be more of a base. Now, of course, we always have to consult the outliers as well. So let's take a look at a few of my favorite. The TLT is the treasuries, the 30-year treasuries. Everybody's getting real negative, of course, feeling that the Fed is going to be more into tapering, and also the potential of raising the rates as inflation takes hold. But the Fed is still pretty convinced that the inflation that takes hold is transitory, thinking that this has a lot to do with getting back to work. Whether you agree with them or not, it doesn't matter. The point is that we're going to see what happens here with the TLTs, because at this point, we're still in a bearish phase. It's under the 50 and it's under the 200. We did have that peak bottom back here. And if we can get back over that 50, really, that tells you one thing. But to me, if it gets back over 140, it's saying that the rates are still ready to go down. And at the next June meeting of the Fed, I would expect them to continue their more dovish stance. We also have to look at the dollar. Now, of course, my preferred instrument is DXY. It's a continuous contract, but we can get information from here. You can see that this too had a peak bottom down here, and so far we're getting higher lows, but the bounces are also getting shallower and shallower. I'm afraid about the dollar. Of course, I've talked about this a lot. I'm worried about the dollar for many, many reasons, not even just the inflation reason, just mainly because of cryptocurrency and digital currency, and just the credibility of the United States overall. The threat of this as its world's reserve currency is something that I worry about. But for now, we can say that with this weakness, we don't get really too upset unless it breaks this pattern of higher lows, which means if it breaks down now under 24.22, that would be something that would worry me. And I would certainly be looking at other sort of defensive plays, especially in gold, which we'll look at as our last chart. Our next to last chart is my other strong indicator on risk, which is the junk bonds. Now, the junk bonds here, I'm going to the StockCharts 50-day moving average and the moving average that I use on TradeStation are different. So sometimes I just want to do a little bit of comparison, because this is what I look at. If I put that, you can see this is how I see it on my charts on TradeStation. So essentially, with the junk bonds, we broke down under the 50-day moving average for 2 days and got a weak caution phase. And that's what got people a little bit nervous, including myself. However, now we've popped right back over the 50-day moving average. If we go down here to the real motion indicator, it's also really weak. We're still seeing a divergence. If this gets back over the 50 and this can hold a second day on Monday over the 50, that would be a good risk on indicator. Conversely, though, and this is one of the most reliable indicators, by the way, if we get back down under the 50, let's say Monday, means we don't confirm a bullish phase, we go back into a caution phase. This would certainly tell us that that momentum has declined here with the leadership going down. And I would take that also as a serious warning. And finally, I want to show you the gold chart. The gold chart to me is extremely interesting. We've been long gold for a while. I've told you about that. We actually bought it down here at around 162. So we've been sitting with this now for a while. Interestingly enough, if you take a look here at the 200-day moving average, we're still below it. So in terms of gold, we're just in a recuperation phase. So that's something to keep an eye on, because if this starts to get through the 200, that means we're going into an accumulation phase, and that could be very powerful. I like the momentum indicators here. There are no divergences whatsoever. It's above the 50, but below the 200. The leadership is there. And at this point, I just happen to know, looking at a weekly chart, which I showed in my Thursday stock charts, that it's pushing right up against this 50-week moving average. So if it can take that out, then you can see then it looks like gold will go higher, and most likely it'll have a lot to do what's happening with the dollar. So to sum up, I think the most important sector to watch right now is that IYT. Like I said, you want to see that gap filled to 278.12. The second most important sector probably to watch is the semiconductors, because they need to continue a rally and not break 225. And then, of course, in terms of the outliers, watch those rates. We don't want to see yields go up. That would certainly affect the NASDAQ. And watch the junk bonds. And then most importantly, also in terms of the inflation scenario and just the future here of our economic growth, keep an eye on that dollar, because that could be explosive for gold. Okay, that's it for your Daily 5 today. Thank you so much for watching, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.